Okay. Hey guys, as I mentioned in my note, I just kind of went into this thing yesterday in our strategy session, and I got so much positive feedback on it, and people kind of wanting to know more that I just thought I'd record this in a special strategy session, really for Friday. And so I don't know how long this is going to be, but I'm going to get through it, and I'm hoping that you find it helpful. One thing, one thing I swear, one thing I want to mention is I was really thinking about this. The things that I'm going to be talking about actually kind of transcend trading. You can use you can use them in pretty much any aspect of any pretty much any aspect of life if you use your imagination. And by the way, I can't say that I do this in every aspect of life. Lord knows, I've been married 11 years and I'm still trying to figure out that thing. But and various other things too, not just that. So anyway, take it for what it's worth. Definitely applies to trading, but if you really use your imagination, I think you probably find it works for other things too. So I'll go ahead and share my screen here, and we'll get going. So what I was talking about yesterday was this mindset and methods for better trading results. And as I thought more about it, I was just mentioning one aspect of this, and that had to do with like focusing, making sure that your strategy fit what the market environment was. But so I just thought I'm going to kind of run through everything to make this more of an all-encompassing concept for you. Okay, so here's the thing. I was talking yesterday about how market context matters. If you have a particular strategy, you definitely want to look at the market kind of first. You should just kind of have an idea. You should have an idea of the environment that you're trading in. It's kind of like I don't know, swimming. Um, if you're swimming in the river, look which way the river flows. If you can go either way, try to go with the stream as opposed to against it. But one of the things that you want to always be mindful of is like breadth. If it's a tough market, it may be that fewer stocks are working. But if it's strong, there's a lot of stocks working. That kind of makes for easier trades. And you want to be looking all across different sectors to see which sectors are working the best. I'm not going to show any charts in this, but as I'm doing this, as I mentioned, energy's been in the doldrums for a long time, but it does seem to be working pretty well now. And I think, but I don't know, the market's going to tell me. I think we're going to start seeing more strength in these energy stocks. Again, the market's going to tell me whether it's actually going to do that or not. I think I don't know. A lot of times I see some people on TV talking about certain things that are happening and are going to happen. And then I look at the charts or I look at the market and I don't see any of that. And so then that leads me to conclude that this person, it's not like they don't know what they're talking about. Not at all. Most guys on there are pretty smart. But it's not that. It's that they are kind of predicting the future based on things that they see. Well, I see a changing dynamic here, or there's going to be more demand for energy, for oil, and then at the same time, we don't have enough supply, so there's still needed to build more, and therefore, I'm looking at the oil and gas equipment, the services, these kind of stocks, these kind of companies are going to be doing really well because of the increased demand, because of a lack of supply, and maybe a lack of ways to increase supply. I'm not using the right oil and gas terms here, but I don't care. The whole point is you can kind of extrapolate into the future, look at the current dynamics and say, okay, this is how I think this will play out. That's fine. But then the market has to agree with you. Because if the market doesn't agree with you, now you're just being stubborn. And being stubborn is generally not particularly profitable. So I want you to be keeping that in mind. But also, just this one more thing: when the opportunity is obvious, and I don't mean when it's when you say, "Oh, this is a can't lose thing." No, I mean when, like a while back, we were looking at the quantum computing stocks. We also saw the Bitcoin miners. They all started working really well at the same time. And so when that happens, and then each day confirms the move, that's when you look at it and say, wow, these things are just getting going. And I'm seeing it. I'm not predicting it. These things are really getting going. So I'm right about this trade. Like, I'm right about it. And when you are right, you want to get paid off. You want to get paid off because a lot of times you're going to be wrong. And so when you're wrong, you don't want to you don't want to pay a big penalty for that. You want to say, okay, crap, this is trading. It's not winning. So sometimes I'm going to be wrong. So I take a little bit of a penalty. It's kind of like playing poker, and then the dealer, gives you your hand. You look up and you got rags. You got nothing, and you've already got an ante in the pot. And so you just fold your hand and say, I know I'm not going to win on this, a five and a two or something. So on the other hand, when you've got really good trade going, again, it's the whole sector thing going. When you've got that, that's something that you can sink your teeth into and say, all right, if I can really get paid off on this trade that's working so well, that will more than make up for all the little losses that I've taken. So that's what I mean by trade more aggressively when the opportunity is obvious. And the obviousness of the opportunity derives from you actually being in the trade and making money. That's an obvious opportunity, not the one where you look and you say, oh my gosh, it hasn't happened yet, but this is a can't miss. There's no such thing. There's plenty of missing going on. And so if you are struggling, and this was kind of the key part of what I was saying yesterday, if you are struggling with your trading, don't skip the most obvious part of the struggle. A lot of people go right into, I can't trade, I'm crappy, I'm stupid, I'm really emotional, I keep doing the same thing again and again. And they sit there and they look in the mirror and they're really mad at the person that's looking back at them. And they start just like flogging themselves emotionally. Now, that may be the appropriate thing. However, what you first want to do before you even get to that, what you first want to do is say, all right, well, let me check my strategy, because maybe the strategy that I'm using, maybe there's some holes in it. Maybe there's something that I'm missing that's not a part of my strategy, or even perhaps maybe I've deviated from my strategy. Okay, well, so let me figure that out. What's been my deviation? Or, hey, maybe I have a really good sound strategy, but the market just isn't really rewarding me for that. I mentioned this morning in my in my note that I remember ages ago, like decades ago, when Willie Nelson had that hit on the road again, and all the young folks didn't really know who Willie Nelson was. Like, he wrote some hits way back in the day. I think Patsy Cline had a couple. He was a really kind of well-known guy in the country genre. But then for a long time, he kind of all the young folks grew up and they didn't know who Willie Nelson was. They were more into Ricky Nelson. But then he writes this song on the road again, and suddenly the radio picked it up. That's when radio actually meant something. And the next thing you know, he's got this big hit, and everybody loves Willie and this and that. And so he was asked in an interview by somebody, so what did you do different? Because you've been kind of obscure for a long time. What did you do different that got you this hit? And he said, just perfectly candidly, he goes, I didn't do anything different. The musical taste just kind of came around to where I've always been. Okay, well, that's something that you can also deal with in trading. You've got the same strategy and you're going to stick with it come hell or high water. You're always, hey man, I got a strategy that works. I'm going to be really consistent with this. I'm going to do real well. Okay. And in theory, that works well. And in certain markets, certainly it will. Otherwise, you wouldn't be so confident in your strategy. But what happens when the market changes? When the market changes, it goes from a really strong market and everything's working to a very weak market or a weakening market, just not as strong as it was. But the high flyers aren't flying so high. The dumpster stocks are still in the dumpster and nothing's really happening. Meanwhile, you continue to trade as if you're trading in a really strong, market. Well, if you have an infinite supply of money, you can keep doing that because sooner or later, market's going to come back around and reward your strategy that works so well in a strong market. Sadly and unjustifiably, it's unfair. None of us have an infinite amount of money, if only. Um, and so what happens is if we just stick to our guns, in any market, you're going to run out of money at some point and you're going to quit the game. So it's just really important first, before you get down on yourself for emotions, for being an emotional trader, make sure that that actually is your issue because it might not be. And so if all you do is focus on your emotions, you're kind of missing the main issue that you have. It's like if your car's not running real well, all you're concerned about is the paint job and you got a bunch of dings in the door and stuff like that, where the real issue is under the hood. So you always want to be looking under the hood first. If you can do that, you're going to wind up doing better and more consistently. So this is what we want to start with. And I'm just going to give you kind of the bare bones of what I call my smart trading process. The first thing is strategy. Your plan has to be complete and it has to be visible. And this really starts with like your stock selection, how you select stocks, what the setup is, and then like what the trigger is. What, like right now, for example, we have a bunch of setups that I'm looking at on my launching pad list, but I haven't seen any triggers today. Yesterday, there were a crap load of them, which is why I put like 5 or 6 stocks on the list. If I like the stock sector, stuff like that, like I did with energy, if I like the stock, then I'm looking for the right setup, and that's just like watch me. Watch me, watch me. Maybe this will be a good trade. Not there yet. And then finally, there's a trigger that literally triggers my attention. And then I will likely suggest the trade, but sometimes I won't because just like, well, the trigger pulled, but it was a misfire. But you want to have this as a part of your strategy, and you need to write down your strategy. And this should not be hard. If it's a really long paragraph, it's too much. It should be bullet points. And then I want you to review those daily and even before each trade. And you can say, because this is what I thought when I first started thinking about this, like crap, that's a lot. That's a lot of time. I'm not going to be doing that, not before every trade. I got enough stuff to do, and I don't want to sit here at my computer all day, every day, studying something that I wrote on the back of a cocktail napkin. It seems kind of stupid. But what I realized is if you've got a strategy, you should not take that much time to review it. It shouldn't take that much time. If you've got a strategy, you review it every day. And maybe the first few times, maybe the first week, hell, I don't know, maybe the first month, it does take you a while to kind of think through it and make sure you've got it all handled. But after a while, it's just going to be trading. It's not anything. It's like, how many shares am I going to buy? How many contracts am I going to buy? How much crypto am I going to buy? Okay, well, that's something that you have to decide. You have to make that decision. So this is really no different. You just have to go through your strategy, make sure that it works for you and it works in this particular trade. If you can do all that, you're going to be fine. Frankly, you're going to be ahead of the game, ahead of most people. So is this resonating with you guys? Are you kind of understanding what I'm talking about? Because it's really important. And then I touched on this a little bit earlier, but I'll get into a little more detail with the market. This is also something that a lot of people can tend to miss. And that is, again, your strategy needs to match the current environment. Breakouts work really, really well in strong markets or in strong sectors. That's where you want to be. You want to really be focusing on getting those stocks with obvious institutional buying. Institutions don't day trade. They build positions over time. So when there's a solid breakout, and I go into what that is in another, in other venues. But when there's a solid breakout, that's when you want to be in because the air is rare. There's not enough. You can get an easy lift in a strong market. But when the market is not so strong, you're going to find that your breakouts are going to fade a little bit. Maybe they're not going to work that well. Maybe they're not going to work at all because they're selling. It's really, really heavy air. And so you got to be understanding of what the market environment is. And then again, in a strong market, are you in the strongest stocks? I hear this diversification is the only free lunch on Wall Street. It sounds so wise. The first time I heard that, hell, the first 10 times I heard that, I'm thinking like, that's really true. Diversification. Okay, well, the S&P 500 has plenty of diversity in it. Dow Jones, not as much. NASDAQ Composite, a hell of a lot more than the S&P 500. The NASDAQ 100, well, 20% of the S&P 500. But if you look at those indexes, okay, some stocks are going to be stellar. Like several months ago, I think for the first part of this year and even beyond, we had 7 stocks that were pulling the market up. And that would mean like 493 were lagging. So your diversification is definitely a free lunch. And I've never had a really, really great free lunch. Yeah, it filled my belly, but maybe sometimes you're either going to barf. Salmonella has that way with most digestive systems. So the issue is diversification is not a free lunch. It produces mediocre results. I tell people when somebody asks, like, how do I outperform the S&P? I'll say, well, buy the S&P 500 and sell way out of the money calls every month. Voila, you're outperforming the S&P. You're a superstar. Okay, I would rather be buying the strongest stocks in a strong market. Then you're making a lot more money. It's like everybody's making money because I don't know what the S&P is up this year, but it's doing great. Okay, fine. Most years, somebody with an investment account is going to be really happy with a 15% return on their money, on their investments, with really not that much volatility. That's great, but I would rather have been in Palantir for like most of my accounts, something like that. I'm not saying that's a way to trade, but I'm giving you an extreme example so that it's obvious to me. Are you being aggressive enough? Again, this is just part of your process. You want to have the right tools for the right conditions, and that means kind of having a big toolbox. You don't just have your one deal on a little tool belt. You want a toolbox so that when conditions change, you can change. And also, as a part of your process, you need to have an attainable reward. Excuse me, still struggling a little bit. You need to have an attainable reward. If you don't have an attainable reward, and this has to be just logical, like higher is not an attainable reward. You need to be able to look at it on the chart. You need to be really good at reading charts because they're the psychology of the crowd. They kind of tell you what's likely to happen just based on support and resistance, based on the rules that you know, your experience, stuff like that. So you have to be able to look at a chart, and you'll see me like drawing these I call them envisioning lines, where I'm saying, okay, this is what I think the stock's going to do. And that gets me to a logical reward. And I don't like to engage in magical thinking. I don't. It's not what I do. I used to do that, and it cost me a lot of money. So I just want to know that the trade that I'm making does have a realistic chance and will probably get there, maybe not, but has a realistic chance of making this a trade that's worth taking, that will give me a profit. The reward, again, has to justify the risk that you're taking, because the lowest risk that you have is cash in your account. So anytime you put money into the market, you're incurring some kind of risk. And so you have to define what your risk is. You have to have this worst case scenario set where if my trade fails, what's the maximum failure that I'm willing to accept? And a lot of times I'll set my stop a little bit looser just to begin with, just because I don't want to. I'll just tell you, I'll peel back the curtain. I don't want to keep super tight stops on things because there's a lot of times there's a chance that a real tight stop is going to be hit. And then the stock moves like you would expect it to. So I'll set a looser stop to begin with, but then my suggestion is don't pile into something with a 8 or a 10% stop. Take a little bit of stock, and then as it's working, you can then start building that position. So that's just one thought. But you have to have your loss has to be financially acceptable. Okay, if I lose here, I don't lose more than 1% of my account, maybe less, but it's okay, not a big deal. So that's financially, but then it also has to be emotionally acceptable, and that's kind of a different deal. You need to really be thinking about that as far as if I take this loss, and like maybe you've set your stop at 2%, like really, really tight, really tight. And so if you get stopped out on that, it's not a big deal. However, if you have been stopped out on the last 8 trades with really, really tight stops, okay, the ninth one, still financially, it's okay. But are you going to be kicking yourself going like, what the heck am I doing here? If that's the case, if you think that that could be the case, then for crying out loud, you got to just say, well, maybe I need to pass on this trade. Maybe I need to regroup a little bit. All of that is a part of managing your risk. But the idea is this: you don't want to get into a trade and then say, okay, well, what needs to happen before I get out of the trade? No, you want to be defining what wrong is, because you're going to be wrong a lot. Great traders can have a batting average of less than 50%. I mean, if your process is really good, you can lose on 2 out of 3 stocks and still do really, really well. Why? Because your winners, you're really compounding those and you're really tunning it on that, and you're taking a bunch of small losses. This all has to do with risk management, guys. It's a very, very important it's probably the most important aspect of trading, because if you're not managing your risk well, you're not going to be in the market for very long. But if you are managing your risk well, you're going to have staying power. You're going to be able to learn a lot. You're going to be able to get a lot of experience without taking much downside, without paying much tuition. Are you understanding this? Because a lot of times people don't think about risk. They just think about making money. They just think about the reward. But you're missing the most important aspect of the game. And so the last one is track your trades. Now, as you guys know, I talk about trade track. I talk about that a lot. And the reason is because I think it's really, really important. And um, like I remember one time, Dean Graziosi, I met Dean. He's like the real estate guy. Not anymore. He, for various reasons, he had to get out of that. I think it was federal law or something. But he was a guy, he'd have these infomercials on all the time. In fact, he actually is in the Guinness Book of World Records for having the longest running infomercial on the planet. Like it was always playing somewhere in some country, some region of the planet Earth for I don't know how many days, months, years, or whatever it was. And I met him over in Austin one time and we were talking and I said, like, dude, I got to be honest with you, man. I look at your infomercials and you are just pounding the table. Like you're shaming people into buying your program. Do you do you think maybe it's a little much? And I wasn't being insulting. We were just having a conversation. And he goes, no, actually, I do that like I intend to do that. And yeah, I make a crap load of money selling these programs. However, I also make investments with people that buy my program because I've made a lot of people millionaires. By the way, so have I in my years here. I hear from you guys. But his point was, I feel like I'm doing people a disservice if I'm not pushing my real estate process because they're missing out on a great way to improve their life, to improve their financial situation. And that really stuck with me, which is why it's been 10 years, I think, since I've talked to Dean, and I still remember that. So the point is, if you're not tracking your trades, there's no way you can be feeling good about the progress you're making because you kind of don't know what progress you're making. The market's good, you're making money. Hey, I'm making progress. Market's not so good, you start losing money and you go, oh, well, maybe I'm not making progress. But if you're tracking your trades, however you're doing it, you could do it on a cocktail napkin if you want. You could create a big fancy spreadsheet if you want. All of those are fine ways to do it, but do something. Do something to be keeping track of your trades. And I got a slide on this in a little bit, but I'll kind of jumpstart it a little bit now. If you can get in the habit of tracking your trades, there's really no way that you will not improve. It's like you won't be able to help it because you'll be more situationally aware of what you're doing. And I've got kind of a little rule for how to do that. But you really want to be able to learn what works. What are you doing that works? Hey, well, I'll do more of that. What are you doing that doesn't work? Hey, I'll do less of that. Like that Dwight, the character in The Office, somebody asked him like, "How do you how do you keep from doing dumb stuff or something like that?" And he said, "Well, I always think to myself, what would a stupid person do in this situation? And then I do not do that thing." Okay, well, that can actually apply to trading too. You don't want to do something that a stupid person would do because that's not the right thing. Though there is one exception to that rule, which I'll share with you in a little bit. But you want to be measuring so that you can adjust, and then that will improve your trading. And then finally, with respect to, and this does kind of have to do with risk, I think it's good to be taking partial profits along the way. Like let's say you've got a stop that's you've got a stop that's set at a particular level, and then your trade's working, and then you can do, and this is an easy calculation to do, but you can look at your trade and say, okay, if I keep my stop the same and I sell half of my position, or I sell 18% of my position, you do the math. If I sell a certain amount of my position and take profits, then if the stock falls back and hits my stop, I haven't lost any money. I haven't made any money, but I have a break even. And so I've basically taken out the deductible in my insurance policy. I've taken all the risk out of my trading. Now, you do have the risk of not making a profit, so you can't just look at that as a process, but it's one way to manage your risk. I think it's really an important way. So I want you to be thinking about that. All right. Now, also about Dwight, like I think, what would a stupid person do? And then I do not do that thing. There is such a thing as a mental health buy. And I've heard Dave Ryan, who's an amazing trader, talk about this probably about 10 years ago. And he says, like, there are certain stocks that maybe he's missed his trade, and he's watching it and it keeps going higher, and he starts kicking himself about, like, crap, I didn't buy that stock, I missed it, or I wanted to but I decided not to. What's going on? And so he said he'll do what he calls a mental health buy, where, okay, he's in the stock, he's got just like a little tiny position, but at least he feels better because he's in the position. And then most times, like more likely than not, most times that trade isn't going to work. All right, but he's dealt with his FOMO, and it hasn't really cost him much money. And also then it's reinforced this idea that, you know what? Maybe it's probably not a good idea to just go chasing things. And well, I will show you this chart because I actually talked about this on Google. I feel like I kind of missed it all the way up. And then finally on this day, which, yeah, 11:25, yeah, on this day when the stock was up, I was telling people, I'm going like, you know what, guys? Let's do a mental health buy just because I'm really feeling crappy about not being in this stock at all. So we take a very small position, and it turns out that that's the top. So actually that was a good trade. We're still in it, by the way, and I think it's going to make money. It's just a crappy entry, but that was actually a good trade because my actual strategy was, okay, I don't I think I'm doing something that a really dumb person would do, but you know what? I feel compelled to do it. So what am I going to do? I'm going to go in for just a little dumb, just a smattering of stupidity on this trade. And so I put this trade on, and sure enough, like right away, it's a losing trade. Okay, nice trade, Dan. Well, at one point, it didn't hit my stop here, but at one point, it's down 3.5%. Not a big deal. Okay, well, now it's down 1%. So I haven't been hurt by it, but I sure as heck didn't have the best entry. In fact, by the way, just yesterday, just so you guys know, I did mention this would be a good time to be starting a position in Google if you haven't already, because it's still working. It's still working. It's just been resting, as stocks will do, as the strongest stocks will do. This has been resting, kind of like it did, back here. It was resting back here. This was resting. These are called Darvas boxes. That's for another venue as well. But so these stocks go through these periods of time when they're resting. And so what did I do? Bought right at the beginning of the rest period, but I did it with intention and also with the knowledge that, you know what? Maybe this is going to be one of those Dwight trades. Only I do the dumb thing, but I'm not going to be spending much money doing it. But it made me feel better at the time. And now I feel better too because I learned a little bit. It hasn't really cost me any money, and hopefully you have too. So, anyway, so you just literally, and I'm not recommending this like, hey, that's a strategy. Just do stupid crap all the time, and ultimately you're going to make money. It's just like when you have one of those instances where it's just killing you, buy a share, buy 3 shares, whatever. Mentioned the other day about Broadcom. Okay, if you buy 3 shares, spend $1,000, buy 3 shares. Now you're in the stock, and maybe it works, maybe it doesn't. But it allows you to kind of get something on your screen without taking a lot of risk. So I want you to think about this. Again, this is something I mentioned yesterday. Stocks are actually worthless. I've heard this throughout the years. Never heard anybody say this except me. But I've heard a lot of people say this about crypto, that like Bitcoin is worthless. It's a Ponzi scheme. Remember, Jamie Dimon was saying, if I hear of any employee, even if they just bought Bitcoin in their personal account, I'm going to fire them. There's all kinds of stuff like that, and there's still a lot of people that say that, and that's fine. That's there. Everybody has a right to be wrong, but the bottom line is anything has value that people are willing to pay for it. Way, way, way back in the day, there's tulip mania. People were paying all kinds of money for tulips. Okay, well, those tulips had value. They had a lot of value. You could say, well, they were overvalued, but not at that particular moment in time. There's a bid and there's an offer. The issue with stocks is they have quarterly earnings. There's surprises like Netflix is buying, or they've signed a deal to buy Warner Brothers, I think it is. And so Netflix took a big dump because they're part of the deal is they're issuing stock. And so this had a really, really nasty move down, but you can see what's happened. It's still down 3%, but at one point, it was down. It was down a lot more than that, almost 5%. But this was the type of thing where right out of the gate, this thing gapped down. People looked at this and said, hey, this thing has value at $99, $98. And so they start pushing the stock higher. All right, well, then now this is back down to $100. So has anything changed in the deal? Has anything changed in the arrangement between Netflix and Warner Brothers? Anything changed? Oh, well, the government, that's going to be like a stupid monopoly. And then nobody cares about making big feature films anymore because it's all on Netflix and you're going to be watching it on your TV. That eliminates competition, and competition is what is what spurs more creativity and all that. So there's definitely an argument to be made that this is a negative thing. Okay, who cares? I don't care. You shouldn't care. The market prices this at $98 at the bottom. Okay, well, what, an hour later? An hour and a half later, the market was pricing it at almost $105. The only thing that has changed is the psychology of the market. There's no change in intrinsic value for these stocks. And so everything is psychology, and that's why I say stocks are worthless. They're only worth what people pay, what people are willing to pay for them. They're not as valuable as dirt. Because at least with dirt, you can put seeds in there, you can water it, and you'll get a plant. Unless you're a really bad gardener. You can't do that with stocks. And so what we look for is institutional buying and selling. That is what's the most important thing, is what are the institutions doing? Understanding how that works, that's priceless. So we don't buy the worthless stocks. We trade along with the institutions who just happen to be trading stocks. That's what it is. That's the game. Also, don't obsess over a celebrity stock. I've talked about this several times about Nvidia, and people used to be talking about Tesla to a certain extent. People still do. These stocks that have done so well in the past that even when they stop doing so well, like they were a superstar, now they're an also ran, um, you you can fixate on that because why? Well, I just want to get that good feeling again. I made so much money on this before. When is it going to do it again? Or I totally missed the trade, but I'm not going to miss the next one. So they keep following the stock as opposed to saying, wait a minute, that was a good pattern. It just so happened to have the ticker NVDA, but that was a really good pattern. Or RGTI, that pattern was the same as NVDA. Let me find that pattern again. So if you're looking at a pattern as opposed to a ticker, trust me, you're going to do better. I can promise you that. I promise you that. Okay. Also, stop discipline. This is a noun, not a verb. Um, Stop discipline. Stops and shakeouts are part of the game. Most on your good trades, you never need a stop. Your really profitable trades, don't need a stop. Don't need stops. Stops don't work. But then if there's a losing trade, suddenly you do need a stop. So you need to have your risk defined on every single trade that you make, every single one, and be happy when your stops are not threatened, but still have them there. All right. That matters. And also you get stopped out once or twice on the same stock. I just have a rule. It's just my rule. If I get stopped out twice, I'm probably, maybe I'll go in a third time, but for me to be stopped out twice tells me that maybe I'm wrong about the trade. Maybe I need to just move on. But if I get stopped out three times, I'm done. Like that happened to me on Oracle. I'm still talking about it. That happened to me on Oracle probably 15 years ago. I just couldn't make money on that stock. I still hardly ever look at Oracle. Um, I hardly ever look at Oracle, and it's not like, oh, it's got bad juju. I just kind of got used to not looking at it. And so if I was still trading Oracle, I'd have bought it right here. No question. I bought it at $344, 345.72. And I'd still be riding that thing down here, almost 40% down. Why? Because it's Oracle and it's got my number. Okay. I'm a little pin cushion for Larry Ellison. So I just don't trade Oracle. Okay. Well, there's like over 6,000 stocks to trade. I don't think I'm missing anything on Oracle, but that's just something that I set for myself. I look for patterns. And by the way, if I saw a strong pattern on Oracle, I still wouldn't trade Oracle, but I would trade that pattern that happened to be in ORCL. So if your stops are failing a lot, or if you're getting shaken out, again, don't just look at yourself and say, I'm looking at stupid. Check your strategy. Make sure that it's working for you. And then also, again, I mentioned this, keep tracking your trades, but, and this is, it's actually kind of a separate, it's a part of it, but it's kind of separate too. Keep a daily log, keep a brief log of what you're doing, maybe how you're feeling, how much sleep you got, how many trades you had, anything in a particular trade, but something, it's kind of like a diary. Just keep a diary. And then you'll have more self-awareness. And if you say, well, that's a pain in the ass. I tried that once, didn't work. Okay. Do what I call the rule of 10. Other than holding your breath, anybody can do anything for 10 days. You could even fast for 10 days. You'd be good. You'd be thinner, but you could do it. My point is, follow the rule of 10 for 10 trading days in a row. Keep a log. And I've actually done this when I would really struggle with having the discipline to engage, to adhere to a fitness routine. And I'll be candid with you. if I'm going through a period where I'm kind of depressed, I'm not feeling good about myself, and stuff like that, and it definitely happens. I have a really hard time going to the gym and working out because I kind of, in a way, I feel like a loser. I feel like I'm not worth it. I would rather I would rather sit down and eat some ice cream. I don't really do that. Or see if I could find the bottom of a bottle. So I don't do that either, but you get my point. Um, I just don't feel motivated to go in there and really flip and sweat. And so what I've done in the past to get out of that is gone like I tip my hat to that and go, you know what? I don't flip and feel like working out, but you know what? I'm at least going to go to 24-hour fitness, walk in the door, just walk in the door. Maybe say hi to the guy at the front who wants me to flash my QRS code, or maybe not, but I'm just going to go in. And that's enough because it's more than I did yesterday. And I have done that. But then what happens is I'll go like, okay, that's what I'm going to do, but I'm going to put on my workout clothes too. Last time I had my jeans on, they don't allow that. And so I put my workout clothes on. And then what am I typically going to do when I'm really trying to get out of the doldrums? I'll walk in. Maybe I'll do 10 push-ups. Maybe I'll go over to the barbells, to the dumbbells, and get some 20s and just do biceps curls. That's it. One set, maybe three or something like that. And then I go out if I feel like it. If I'm going like, okay, God, that's enough. I'm such a worthless sack of crap. I don't want to spend any more time on this. I think I'm going to stop by Baskin Robbins on the way home and do what I really feel like doing. But over time, that habit progresses and you get further along. You get further along on a good habit. And then before you know it, you're back to a consistent fitness program and you're feeling a lot better about yourself. One thing that I've done recently, I'll maybe give you a little too much information just because of time constraints and some various other things. I've had a lot of a lot of stress away from Stock Market Mentor, just a different business thing that's been freaking driving me nuts, keeping me up at night. And so I'm feeling like, you know what? I don't have time. I just don't feel like going into the gym and working out. I certainly don't feel like taking a 3-mile walk, which is what I used to do, because I don't want to be thinking about all this stuff. And so I just was kind of having a hard time getting motivated. Then I found HotWorks. And this comes into logging your trades. It comes in to just showing up, which is what I say, like Woody Allen said, 80% of life is just showing up. So HotWorks. I'm a San Joaquin Valley guy. I've lived over in Las Vegas. I love the heat. Can't be. If there was air on Mars, I would go there. That's fine. Um, I love the heat. I thrive in heat. And so I heard about this HotWorks deal where you go in and there's various infrared saunas. One of them has these bikes, with the handles on them and stuff like that. And the workouts are like 15 minutes. That's on, like a little video camera with three people that are smiling to where you just like, I don't even want to look at it, because the one thing I hate is to see somebody as I'm working my ass off, sweating, see somebody else who's on a set and they're not sweating at all. And they're going like, you can do it. You can do it. I want to throw my bottle at the TV. Okay. But you know what I do? I'm going to come in here. I'm going to do one of these fitness programs, which is really only 12 minutes, not 15. And that's what I did the first time. But then that first time I did another and another. I was in there for a little over half an hour. Why? Because it was fun to me. I was getting a lot out of it. But it started with me saying, you know what? I can do 12 minutes and I'll get a good workout in. And then I'll kind of feel a little bit like I worked out a lot. It's just like if you didn't work out at all, but you go by the water fountain and throw a bunch of water on yourself so it looks like you sweated. But it was a little trick for me. I just did a little trick, kind of like keeping a daily log for 10 days. It's a little trick you do, and then you get into a habit of doing it again and again and again. This is all about this stuff that I'm talking about as a habit. If you have a habit of doing the right thing, You have a pattern of doing something that's not working. If it was working, then that's a good habit to have. But you got a pattern of doing something that's not working, whatever that is. That's your pattern. So you don't eliminate that pattern, you replace it. You replace that pattern with a good pattern. And over time, because it's self reinforcing, it works, then it becomes a habit. And then once it's a habit, it doesn't take any discipline. It doesn't take me any discipline to fasten my seatbelt when I go sit in the car. I just do it without thinking. I challenge you to do otherwise. That's not a habit, even. That's just something that you do. So if you can start with doing this 10 days, or even like I'm going to do it in 10, do it for 5 days, but do something. Get off your ass. Just get off your ass and do something. Motion creates emotion. Emotion creates more motion. So just do something. And then with respect to trade track, yeah, I wrote this software. I hired somebody to do it. Wrote this software program. Okay, I have a lot of people using it and they're getting great results, but others you'd be resistant. You go, I'm not going to do that. Okay, so I'll say, track just one trade each day, even. Or say like, all right, well, I'm going to track 1 out of 10. I hate tracking my trades, but you know what? I'll do one of them. I'll do one a week. Do something. See if it works. Maybe it will, maybe it won't. But if you get to where this is a consistent thing that you're doing to where it becomes a habit, you will find that it works really, really well. Like I'll take just a second to do this on the. I'll show you what the benefit of this is. And it's Friday, so I still need to be inputting, doing a little bit here. But this is my track for the active trade list. I put all my trades, and again, you can see like some of them I haven't put on, but then that's why. Uh, Hang on just a sec, I'll show you. Okay. Um, because I don't do this every day. I do every trade, but not every day. But this is why when I put on a trade, I annotate it. Okay. I'm going like, well, what day? When did I put this on? When did I put this trade on? I go here because I always do this on the same day. Oh, okay, 12/3. This is when I put this trade on. All of this is 12/3. This was my entry. This is my stop. Definitely, if I'm going to raise the stop or something like that, that trade's already logged. But I don't fill out trade track every day, but I still track my trades just with these annotations, right? And so then I put this stuff on the list. I've got sizes and stuff. I've got R values. Okay, the R value like TMDX not doing so good now, although I think that yeah that closed out. Okay, so it's looking like I've got a really real stinker here down 2.3 on the R values, but I haven't closed that out yet. And so that's kind of a reminder. And then I can look up here. One stop triggered, review it. What's your current risk in your account? So I look here. Oh, TMDX was hit. So rather than just close this trade out now, I'm going to go back and look and see, okay, where exactly was that stop hit? Because, I didn't close this on trade track on that day, but I'm still ultimately doing the same thing. And this also shows me, where am I? What's the status of my account right now? And if all of my stops are hit, I'm losing almost 100,000 and I'm losing 4.75% of my current equity, which is actually less than that. I haven't adjusted this either. So I'm actually a little bit behind on this. So anyway, but this stuff, guys, I'm telling you, it works for you. It will work for you. You won't be able to help it working for you. And you can also actually uh, you can use this. This is just on calm. You can use this and say, okay, well, this is when I bought. This is where my stop is. Maybe I need to raise the stop a little bit or not. But you can do this kind of thing on this. Again, use Trade Track, use Excel, use whatever you want, but do something to track your trades. Just do one. Do one a week, one a day, but at least do one. And so the point is, show up. Just show up. Do something consistently. Just show up. Like I said, I mentioned this earlier. Woody Allen said 80% of life is just showing up. But if you can always be present, always be trading consciously, do things in a consistent way because you're thinking about it, ultimately you're going to get to where you're trading perfectly. Now, perfectly does not mean 100% winning. Perfectly means every trade is done the right way. You're never quite going to get there, but ultimately you'll get really, really close. So don't strive to be perfect. Just show up and be focusing on the things that I've just talked about. So is this making sense to you guys? And one thing, I just put this on at the end just because I could. If this is interesting to you, as far as tracking your trades, you can either go to, you can go to Trade Track. It's right there, app.tradetrack.com, or I think it's ultimately, yeah. You can go to app.tradetrack.com or just pop the QRS code, either way. But it's something that you should try. You should definitely try it. But I'll say it again. There's a million ways to track your trades. I just created one that I thought is the easiest way for me to do it, but it's not the only way. So you figure out what works for you. But if you can really, really, truly get through this, get used to doing like a smart type of trading strategy. You've got your strategy, you've got the market handled, you've got what your reward should be, you've got your risk defined, and you're tracking your trades. If you can be doing that, guys, think about it. Is there any way possible that you cannot improve? There's no possible way that you can avoid improving if you're doing this kind of stuff. And for the most part, like other than if you've got a subscription to Trade Track, all of this stuff's free. You can do all this stuff. It doesn't cost you anything to do it. And even you could do it on your own. Get a cocktail napkin. I don't have one, otherwise I'd show you. But just get something to track your trades, and you can do all this stuff for free. All it takes is time and effort. Okay. Okay. I got to go pick up Scott. Actually, I'm a little bit late. He'll understand. But okay. All right. Yeah. One person, Vince, goes, I love Trade Track. I wish it had better option functionality. We're kind of working on that, guys. But I have realized 100% I'm more consistent and disciplined when I use it, and my equity curve is way more stable. Okay, Vince, that's about the best. That's about the best feedback I could get, because what you're not talking about is, hey, I made $1 million, or this and that. You're saying like your trading is more consistent, and that's what it's all about. So thanks for sharing that with me. So, okay, one other thing, and then so I'll end this here. Okay, I'm going to end this session here, but then I see Richard, you've got I don't know about I think you said REGI, but I think you mean R. Rigetti. Has my opinion changed on that? No, well, the stop got hit. The stop got hit on this, and so yeah, my opinion's changed. This move did not work, and so we'll take the we'll take the loss, whatever it turned out to be. I set this pretty tight, something like that. So it's like a 5% loss or something. I think ultimately it has a chance to go higher, but the stop was what it was. It is what it is, and so this trade is done. So anyway, okay, had a great week. Account at high of the year. Have a good weekend. Guys, your profits are my pleasure. That's what I love. Okay, can I post a video on Telegram? Yes, I can do that. We'll get that thing handled. So, guys, I love you. I'm glad I was able to do that. And by the way, I feel so strongly about this stuff. This is for everybody. I'm sending this out even to people that are not members of Stock and Option and Crypto Market Mentor. I think it's a really, really important thing for you guys to be thinking about. It's really important because this is the this is the free lunch, frankly. If you apply this smart trading process, I've pretty much encompassed everything. Okay. I'm just glad there's an S and an M in there as opposed to starting with finances because FART doesn't quite have the same meaning as smart. So just go ahead and do this, guys. And I challenge you to not trade better because you will. All right. That's it. I'll see you guys next time. Hang on just a sec. I like to look you in the eye. So just do this, guys. All right. It'll pay you dividends. By the way, we're less than a month away from New Year's resolutions. So make this a New Year's resolution in 2026. Should be pretty flippin' awesome. All right. Okay. I'll see you guys next time. Have a good weekend.